Hi, thank you for your interest in Onfolio and our preferred shares. I've had a load of questions come in, a load of comments, and I recently sent out an email asking people for their feedback as well. And thank you to everyone who responded to that because I got a ton of really good feedback. So I decided what would make sense would be to just record a video talking a little bit more about Onfolio, addressing some of those comments, answering some of the questions, and just generally showing you who I am and things like that. So I'm Don Wells. I'm the founder and CEO of Onfolio, and I'm just going to start off with a bit of an overview about Onfolio and the preferred shares, and then I'll go into some of the questions. If you do have any other questions that aren't addressed in this video, just reply to the email that you're receiving this video in, or just reach out to Dom, D-O-M, at onfolio.com. Okay, so a little bit more about Onfolio. We are a publicly traded company. We're listed on NASDAQ. And we buy already profitable businesses, and then we just take over those businesses and we run them. And the idea is to grow them where we can, enjoy the cash flow, take that cash flow and buy more online businesses. Where we're at right now is we are looking to raise some more money, about $10 million from preferred shares to accelerate our acquisitions. And the thing about the preferred shares is they're not currently listed on NASDAQ like our common shares are, but they will be listed soon, not on NASDAQ, but on one of the other US exchanges, so that anyone who invests and picks up some preferred shares will be able to sell them later, should they wish to. Why did we choose preferred shares rather than, say, traditional debt? It's a little bit a function of where we are, the size we're at, the revenues we have, a little bit of the fact that the credit, where we are in the credit cycle, and debt is not as easy to get as it was about a year ago. With Silicon Valley Bank and some of the other banks collapsing, that's made the situation worse. So we could get some debt, but it's not really enough for what we want to do. And we're actually in a position where a lot of other companies aren't. Because we're publicly traded, we have this ability to have a preferred share, and preferred shares are typically interest only because you're buying the share, we're paying you a dividend, and then if you want your money back, you just sell the shares to somebody else. So we don't have to amortize that and pay back the principal over time like we do with debt. So preferred shares actually allow us to do two things. The first is because it's interest only, it cash flows us better. Because we're just paying back the interest, not the principal. And the second is because of that, we can do higher dividends. So you might be thinking, how can they afford 12%? And it's because we're only paying the interest. We're not paying back the principal. You get that back when you sell a share in the future. So that kind of gives us a unique opportunity where we think, well, we could go out and get some debt. Maybe the debt is, the terms are not that favorable. The amount we can get is not as much as we want. Or we can use this publicly traded vehicle that we have and issue preferred shares. And we actually first issued preferred shares in 2021 when we were still a private company. And it was more challenging to raise money then because we were private, we were unproven, we didn't have any track record, we hadn't really demonstrated that when we buy businesses, they stay profitable. And now we're public, we've made a lot of acquisitions, those acquisitions are going well, and we have a 2.5-year track record, plus we have SEC compliance, audited financials. So we said, you know what, we should just raise more preferred shares, that makes the most sense for us. And it's great for investors as well. So that's the idea. So we'll use the money we raise. We're looking to raise about 10 million, but if we only raise 5, that's okay. And the idea is take that money, buy more online businesses, and just get profit from those businesses. And normally, let's say if we raised $1 million, we would buy a business that would maybe make us $200,000 profit, 250, maybe 300,000. We wouldn't necessarily have to pay all the cash up front either, so maybe we could get 400,000 profit from $1 million. And $1 million of preferred share dividends is only 120,000 that we would be paying out to investors such as yourself. So there's pretty good margin there for us to pay those 12% dividends. We could do 10%, we could do 8%, but I think given that you can get 5.5% from treasury bills right now, nobody would be interested in investing if we only did, say, 10. Now, we could also do 15, and some people have said 12% is not enough. But I think if we increase the dividend too much, it also increases the risk. So it's about finding the balance between wanting to provide an attractive return for investors who think, you know what, I'm going to do the hard work. I'm going to research this company. I'm going to see if they actually are worth an investment. I'm going to watch this video. If we were just offering 7%, you wouldn't bother. And so it's about finding that sweet spot between what's the most we can give investors to attract them, but not too much that it doesn't make sense. We've actually, one of the comments I'm going to address today is, some people have said 12% sounds too good to be true. So imagine if we did 15%. So it's really about what's the absolute most we can do to attract capital quickly so that we can close some of our acquisitions without being unrealistic and being unsustainable. And 12 is the number we've landed on. And again, we've bought many businesses with the money we raised in our IPO, and all of those, the cash flow that they've produced over the last year or 2 years tells us that, yeah, we can comfortably afford 12%. 15, we can do it, but it doesn't leave much profit. So what's the point? So that's where that number comes from. That's where the whole idea of the preferred shares comes from. And that's really it. So I'm going to talk a little bit more about the businesses we buy. That's actually one of the questions that has come up a lot that I'm going to be addressing. But I want to jump in with some other questions first, some of the more common, frequently asked questions, basically. So one question that we've been asked a lot is actually kind of about the difference between the preferred share and the common share. So the common share is listed on NASDAQ, and you can buy it with a brokerage account like Schwab or Robinhood or whatever you use. And the preferred share is not. The common share doesn't come with a dividend. You just buy our common share because you believe that as the company grows, the common share is going to go up in value. The preferred share probably won't change in value. It'll probably stay at that kind of fixed price that we sell at. Of course, like supply and demand, it may go up or down a little bit. The preferred shares are really for people that want yield. They just want the dividend. And so someone said, why are you selling preferred shares for $25 a share when, the common shares are only $1? And the answer is they're just different things. You can't buy the preferred share for $1. Preferred shares, 9 times out of 10, they're sold for $25. That's just the price that's been established, regardless of the company. There's dozens of different preferred shares out there trading. They're all listed for around $22 to $26, just depending on the way it's gone. And so that's just the price that, that's just, it's kind of arbitrary. We could have sold them for $50 a share, could have sold them for $10 a share. It doesn't really matter because the 12% is tied to that cost of the share. So if you buy a share for $25, it comes with a $3 dividend because that's 12% of 25. So it's, it's kind of irrelevant. Another one which is related to that is people have said, what's to stop the shares dropping in price once they're publicly traded? So, let's say you decide you want to buy $25,000 worth of shares. You buy 1,000 shares at $25. Maybe a year from now, you've collected your dividends, but you decide you want to sell, get your $25,000. What happens if the shares are now $20, $15 a share? I would say it's pretty unlikely because while our common shares, you can see the performance, they go up and down, and generally they've trended down a little bit in the market that we're in. Preferred shares have that fixed yield tied to them. They have that dividend. So there's a lot more demand. You can see, for example, most of the recent preferred shares that have hit the market have had like a 7% dividend, 8%, 8.75, 7.75, even some are like 6.5. So if you're someone who's looking to buy preferred shares and you see some are 7%, some are 8%, and Onfolio's is 12%, you're probably going to buy those ones. So that's going to create demand for the share. Not only that, but we've got a 2.5-year track record. By the time we list the shares, it might be closer to 3 years of on-time payments. We've never missed a dividend payment. So that's going to bring demand for our preferred share as well. The other thing is right now, only accredited investors can pick up our preferred shares. But once they become listed on the exchange, anyone can buy them. So there's a lot of people who can't buy them yet because they're not accredited. Those people will buy them once they hit the market. That's going to create demand. The other thing is, realistically, most people aren't going to be selling anytime soon. There's some people who've held shares since 2021. Yeah, maybe they'll sell some once they're first listed. But if you're looking at this investment, you're thinking about the yield, right? So you're thinking, oh, I'm going to hold for a year. I'm going to hold for 2 years. Maybe you're going to hold forever and just collect the dividend. So when we first list the shares on the exchange, who's going to sell? Most of you are holding. If you're going to hold just for a month and then sell, or 5 months or whatever, it's probably not worth your time. So who's going to be selling? So therefore, there's going to be more demand than there is supply. And so maybe one person comes in and just dumps their shares for a few days and the price dips to 23. But then all those other people who are like, yeah, I can't actually buy any because there's none listed, they'll bid the price back up again. A similar example, again, what happens with another company, you can't assume it's going to happen with us. No guarantees or anything. If I was guaranteeing stuff, just stop watching this video now. But there was a company listed, I think they had about an 11% yield, so similar to us. Their shares were listed at 25. They briefly traded down to 22 for a few days because somebody sold a bunch. People came in, bought the shares back up to 25. And I think actually now, the last time I looked, they're trading at 26. So, there's just as much. If you're thinking, I'm going to wait because the shares are going to fall in price on the open exchange, and then I'm going to buy them, well, you just have to think, where's the supply going to come from? Who are you going to be buying them from? Who's going to pay Onfolio 25 and then sell them a few months later for 22? Like, you might get a few thousand shares from someone who's, maybe they need some money for a medical issue or something, but there's just not going to be the volume that you think. Like, if you want to sell, sure, there'll be volume. If you've got $100,000 worth of shares, you want to sell them, there will be buyers there. And those buyers will be willing to pay you 25, maybe even 26, because they can't find something anywhere else. So if you're thinking about the share price, don't buy it because you think it's going to go up to 26, but don't not buy it because you're worried it's going to go down to 20. You just have to think about supply and demand and where is the actual supply going to come from. So another question, can I invest with an IRA? If you have a self-directed IRA and you have a custodian like Alto IRA or some of the big ones, the deal maker platform we use, you can do that. There's some mechanisms involved where you tell deal maker, the custodian, and their employee, their EIN and things like that, and you can do it. If it's a regular IRA, then no, but maybe when the shares are publicly traded, that will be an option for you. So another question is a little bit, how long do I have to invest? Is there an exit period, that kind of thing? So SEC rules are that once the shares are publicly traded, you will have had to have held them for 6 months before you can sell. So let's say you buy today, we list the shares publicly in a month, then 5 months later you can sell. That's not something we've done, that's the SEC's rules. If we never list them, you have to hold them for a year before you can sell them, but we are going to list them. So think of it as around 6 months. And really, if you want to sell in less than 6 months, it doesn't really make sense to go through this hassle just to hold for a few months. But yeah, once they're publicly traded, you can sell them. And you pass that 6 month window, you can sell them anytime. So another question is, this one's a bit of a long-winded, a bit of a longer answer, but if Onfolio buys profitable companies, why aren't we profitable ourselves? So that's a good question. I've also had a few similar questions, which are, if you buy a profitable business, just because it was profitable before you bought it doesn't mean it's going to continue to be profitable. Really valid point. And that's like 90% of the work we do is trying to figure out if the business is going to stay profitable and if we're the people to keep it profitable. So I'm going to answer these questions. I'm just kind of grouping some of them together. Okay, yeah, I think those are the relevant ones. So the main one about if we buy profitable companies, why aren't we profitable? The answer is we just haven't bought enough profitable ones yet. So being a publicly traded company comes with fixed costs. You've got insurance, you have the NASDAQ listing fee. We do SEC audits every quarter and then a big one at the end of every year. Our lawyers are quite expensive. we have a board of directors, we have my salary and the other members of the C-suite, like the CFO's salary. So these are things that are not, initially covered when we buy a business. And so we have these high fixed costs, and we've bought enough businesses to kind of close the delta to about here. And then we buy a few more businesses, we'll be profitable even with the dividend payouts. And then from there, the idea is to rinse and repeat. So it's really just, we probably need to raise maybe 3 to 4 million of the 10 million that we're raising in this preferred shares raise to reach profitability. We already know which businesses we're going to buy. We've done the maths and the modeling and said to ourselves, if we buy these businesses and they suffer a performance drop or something like that, is it still going to work? And yeah, we're very confident there. Past successes don't guarantee future results. There's no indication you will be able to continue to buy profitable companies, nor that the companies that you have purchased will remain profitable. So I think that's a good point. I think saying there's no indication that we're going to be able to continue to buy profitable companies is a little, maybe not understanding the space, because there's hundreds, maybe even thousands of profitable online businesses out there in the size that we like to buy and that we feel good at operating. And there's new businesses being created all the time, just like there is in the world. So as long as there's internet, people buying stuff on the internet, or people paying for services on the internet, or consuming content on the internet, there'll be businesses for us to buy. Now, I think a much more important question is the second part, where this business said there's no indication you will be able to, there's no indication that the companies that you've purchased will remain profitable. Yeah, 100% I agree. 80-90% of what we do in our due diligence is asking this question. We don't want to buy a business and then 2 months later it dies, or even 2 years later it dies. And so this is a huge part of our due diligence. Maybe I should even do a whole separate video about this. But when we're looking at a business, the first question we're asking is this business going to die? And then the second question is, can we grow it? Because I think a lot of people get more excited about growing a business and not asking themselves, well, how sustainable is it? And how we ask that question is, we look at the trend of the business, we look at the space and how many competitors it has, how easy it is for another competitor to come in or for someone to copy the business, how long has it been around, is it like a real business? So sometimes you get somebody, they build up a big social media following and then they sell services to their followers. That's not really, that's good money for them, but it's not really something that somebody like us can buy because it just relies on somebody else's social media presence. So we ask ourselves, how reliant on the founder is it for generating business, for closing sales, for fulfilling whatever it is that they're selling? I think the biggest reason we walk away from most deals is because we can't kind of reconcile with that question. We look at the financials. Is the business up and down? Does it require us to keep throwing more cash in to keep it running? Is it something that we feel comfortable that we can hire a team to run it? If we hire a team to run it, is it still going to be profitable? We ask ourselves, do we understand it? Are we able to even do due diligence on this properly? And so this person who said, there's no indication you'll be able to continue to buy, that the businesses you buy will continue to stay profitable. Yeah, I would say that's it. Basically, that's the entire business model, is finding businesses where that is the case, where we think strongly that they will continue to be profitable. So yeah, I'm really glad somebody brought that up, give me a chance to talk in more about that. Somebody else, actually, a few people said the dividend seems too good to be true. We could offer 10% if you wanted, but no, I'm not trying to be flippant here. Like I mentioned earlier, it's really finding the sweet spot between something that's attractive enough for you to be willing to sit through this video and hear me boring you. If I said it was 10%, you would just say it's not worth the risk. If I said it was 8%, you would say it's not. Like, why would I pay 8%, 8% when I can get 5.5% of treasury bills? If I said 15%, you won't say, okay, now I'm really interested, but 15% is not sustainable. 12 is the number that we've landed at where we think, yeah, like this is sustainable. And over time, maybe the next ones we issue will be 10% and 9%. We don't need to kind of give people extra incentive because we've been around for a lot longer and there's more demand. So kind of our status as a smaller company with only 2.5 years track record is your opportunity. In the future, it will be 10% or 9%. I think that's really, those are all the main questions we had. And again, if you've got a question that's not addressed here, email it to me, use the contact form, or reply to one of our emails. But just to summarize again, it's really simple. We're an online holding company. We buy profitable businesses. We try to grow them where we can, but most importantly, we want them to sustain those levels of profit. We then take those profit and buy more businesses, rinse and repeat. We're offering preferred shares because it's a great way for us to raise capital for additional acquisitions. And the reason it's 12% is because we know if it's less, you're not going to be interested. And if it's more, it doesn't make sense. It's not sustainable. So it's the sweet spot between risk and reward, I guess. So thank you for your time. Thank you for watching this video. Thank you for your interest even before this video. Like I said, I'm here if you need me, if you have any questions. And thank you.